Vancouver. There's a lot of fun things you could be doing outside, but thank you for taking the time and the interest to be here and to learn and share your thoughts and insights. We've put together what we hope is going to be an engaging afternoon for all of you. We've brought together speakers, presenters, and we're very thoughtful in the people that we've invited to this event who could join us here in person and virtually, to try and provide something of value. The genesis of this event started probably about a year ago. I came over to DLA, and in the early days when I joined the firm, I had some conversations with my partners, Josh Kaufman, who's here from New York, the co-chair of our capital markets group, and Stephen Wortley, who's one of our partners in Vancouver and New York and has a significant Asia practice. We were talking about how our clients are working with companies, with investors, all over the world, and how we're seeing more and more global interconnectedness. And that was a big part of why I joined DLA. And so we started thinking about, well, what can we do and what's our role in that? And what we were realizing was that DLA provides a significant benefit to those clients. We're in almost 40 countries around the world, and we're able to support those clients across sectors, across industries. And we thought, well, what more can we do? Right? It's not just about the legal services. It's about connecting people, connecting minds, bringing opportunities together where we can connect business leaders, innovators, to provide the value and to provide them with an opportunity to connect with each other. And that was the genesis of this, providing that opportunity to bring people together, to learn, to share, and hopefully grow our capital markets, grow our companies, grow our investment portfolios, grow our wallets, all the good things, right? And hopefully along the way, give back and do something that has a meaningful impact, right? And so that was the genesis of this event. So, we're very lucky. We have almost 60 people here, 70 people here in person, and almost 200 online. So that's quite a significant presence. So thank you for those of us who are joining us virtually as well. We really appreciate you. There is going to be an opportunity throughout the event today for everyone to ask questions. We're going to have two panels, the first on IPO readiness and the second on cross-border listings, cross-border capitalization. And at the end of each panel, there will be an opportunity for people to ask questions. Online, you can include your questions in the chat box, and we'll share them. And then in person, we'll have a team member roving with an open mic. We've had similar sessions to this in Shanghai and Shenzhen, but this is our first such event in Canada. And Vancouver is a fitting spot for this, as capital markets community here is vibrant. It has always been on the cutting edge of nascent industries, and that's in large part with the support of our venture markets. And Vancouver is filled with entrepreneurs who dream big and take action. As we head into Q4 of 2025, it's an opportune time for us to reflect on the market trends that have shaped this year and consider what opportunities lie ahead for us in 2026 and beyond. We've included a few slides in the materials that we've shared with you relating to market trends. So what was 2025 about? Right? 2025 was marked with uncertainty, but resilience. Despite tariff and macro policy volatility, Q1 of 2025 was one of the strongest US IPO quarters in 2 years. US IPO volumes were up 7%, and proceeds were up 60% quarter over quarter. What's driving the market? It's been mega deals. Multiple IPOs in the US have raised over $1 billion, accounting for more than half of the total proceeds in Q1 alone. Major AI deals, LNG, crypto listings have been setting the tone, particularly in the US markets. In 2025 so far, some of the largest US IPOs have been Figma, with $56 billion in market cap, CoreWeave, $55.7 billion, and Circle Internet Group, $40.8 billion. These are big, big deals. So, sometimes we look at that and we say, well, what about the smaller companies? What about the mid-tier companies? Doesn't mean that there's no space for those companies in the market. It's about finding where you fit and finding how to get yourselves there and best position your companies. And that's what a lot of this is about here today, is providing you with tools and ideas and a pathway to find a way for your company to advance itself. Canada's followed the US recovery cycle. Canadian equities have hit record highs in 2025, suggesting that conditions are aligning for renewed IPO activity here as well. On the TSX, year to date up to July, there was about 152 IPOs. On the TSX Venture up to July, we had 39 IPOs. Outside of all these statistics, I think as we were talking and all of us introducing ourselves, there's something that's not quantifiable, right? We're seeing renewed energy. We're seeing renewed excitement. We're seeing increased conversations, increased LOIs, increased interest from people to participate in the capital markets, interest for people to bring new technologies, new ideas, interest for people to invest in those ideas, right? And interest from investors to have their hand in that too. So, we're seeing this trend, and it's not just about the statistics, it's also about, what we see in the conversations we're having in this room and beyond. The level of cross-border activity has increased as well. Notably, the number of foreign issuers listed on US markets has grown from 392 foreign issuers in 2004 to 937 foreign issuers in 2024, representing approximately 12% of all reporting issuers in the US. Approximately 200 TSX or TSX Venture listed companies are currently dual listed on either NYSE or NASDAQ. And 48 TSX and TSXV companies that are currently listed have added NYSE or NASDAQ listings after their original listing on the TSX or TSX Venture over the last 5 years. The main industry sectors that seem to be targeting cross-border listings and getting traction tend to be Canadian AI companies, fintech, and mining issuers. Jamie and I were chatting earlier about the interest in resource sectors and how that's sort of been renewed, right? And those companies are increasingly targeting cross-border listings to provide additional liquidity for their US investors and, in some instances, access US capital pools that are deeper. Now, a question we get asked often is, and I'm sure the bankers in the room all get asked this as well, what industry sectors are getting the most traction and are getting the most money? You'll hear it from our panelists that, there's a lot companies can do to best position themselves to get that interest. And we wanted to share some data in these materials for you on some of those sector dynamics. As discussed above, the main sectors getting traction currently are tech, particularly AI deals, energy, natural resource, crypto, fintech. You can see in the stats and the materials we've provided, IPOs relating to each of these sectors in Canada and the US have been increasing. One trend to note is that the number of IPOs in Q1 of 2025 in each of these sectors, en masse almost, has been increased from the number of IPOs in each of those sectors in 2024. In Q4 of 2024, pardon me. What you can take from that is there is increased interest, increased activity, and I think you'll hear it from our panelists later as well. There's something to be said for momentum. When there's momentum behind an industry, momentum behind a sector, there is something to be said for taking advantage of that momentum and striking while the iron's hot. And the only way you can do that and put your best foot forward as a company is to make sure that you're prepared and ready to do that. So we're hoping today that we can provide you with some of the tools, ideas, and resources to be able to do that. 2025 was interesting. Hopefully 2026 will be even more interesting and busier and with more activity. I think the key takeaways is that confidence is improving. We're seeing IPO pipelines. We're seeing more deals in the pipeline. I think there's about 232 plus pending IPOs with big names in the US who are expected to list in Q4 still. Mining and energy, especially LNG critical minerals, remain central to Canadian listings, while we're seeing AI and crypto and fintech drive some of the US activity. With cross-border capital pools deepening, Canadian issuers can increasingly look south and globally for scale. Canadian companies have opportunities to grow on Canadian markets and leverage the MJDS platform and the foreign private issuer status that they can have to streamline access to US markets and capital pools on both sides of the border. We're fortunate to have a vibrant capital market system here in Canada that can support issuers and grow issuers and can allow issuers to not only take advantage of what Canada has to offer, but use that as a platform to access other capital markets internationally as well. There are increasing opportunities for Canadian companies and investors globally and here in Canada. With that, I'll invite our moderator, Stephen Wortley, and our first panel of speakers, Josh Kaufman from DLA Piper in New York, Jamie Brown from Canaccord Genuity, and Jason Bauer from KPMG to share insights with us on IPO readiness. And as I noted earlier, there will be an opportunity after each panel for attendees to ask questions. And virtual attendees, just a reminder, please use the chat function to ask your questions, and we'll ensure that they're directed to the panel at the end of each session.
Thanks very much, Nafisa. That really set the stage for today's event. It's all about globalization, opportunities, striking while the iron is hot, if you will. And we have two panels today. that are going to help us learn more about those opportunities. But before we dive into that, I wanted to introduce our panel. First of all, my friend and partner, Josh Kaufman, who co-chairs our U.S. Securities Practice Group. Josh and I are neighbors, actually, in our New York office. We joined DLA around the same time. And we've been rowing the globe was probably a bit too much, but we've been spending a lot of time together at the Shenzhen and Shanghai event. We just returned from Hong Kong at a similar event. So I think Josh is well versed and prepared to answer my questions and your questions from the floor. Next to Josh is Jason Bauer, partner from KPMG. Very pleased to have KPMG here and Jason here. Jason and I had some conversations preparing for today, and I think we'll bring out some particular accounting and finance issues as issuers think about going public. KPMG has always been at the forefront of reaching out globally to pursue new clients and help clients cross borders to do work. I know Barbara Livingston is here. I worked with Barbara for many years on similar types of events, and it's great to see KPMG here supporting us today. Last but certainly not least, Jamie Brown, Head of Capital Markets for Western Canada, Canaccord Genuity. And I think in Jamie and in Canaccord, we have a real life example of how the Vancouver market has evolved. Starting in Vancouver, probably you would think of it as a mining firm, just doing mining deals, but it's evolved to so much more. And Jamie's materials will help shed light on that and his comments today. For those of you who don't know, Canaccord obviously expanded beyond Vancouver into the Toronto market in a big way. And in an equally big way, I have a large operation in Manhattan in Midtown. So it's certainly a bank that can speak to a Vancouver audience about what can be done in the U.S. market. So very pleased to have all three of you here today. I did want to raise this book, and it certainly is a book. When you count all the pages, it's quite considerable, but we hope it delivers value and real information. In part 5, and there's a table of contents near the beginning to help you navigate through this, we have presenter materials from Canaccord, NASDAQ, and TMX, which they will refer to during their comments today. So with that, we'll dig into the questions, and I'll sit down for this part. So Josh, you're right here. I'll start with you. And you get this question asked you a lot, whether it's from Canada or globally, when foreign private issuers think about accessing U.S. markets. What is the timeline? What does it look like from the first decision to the first day of trading? And what are the biggest factors that can accelerate or decelerate that process?
Thank you, Stephen, and thank you for the kind words, and to Nafisa for organizing this lovely reception. I would say it's never too early to start. The timeline can be as short as 4 to 6 months, but I would say a year is probably the optimal timeline to consider appropriate preparatory processes as well as regulatory review for most issuers. And it's definitely dependent on circumstances. Obviously, some issuers are already listed here in Canada, in which case they're perhaps able to use the expedited MJDS listing process in the United States. Others, it's an initial listing where they might want to go directly to the United States. In terms of the preparatory processes, obviously you have a formation of an underwriting syndicate. So interviewing banks like Canaccord and others to identify a lead book running manager and others that will provide not just the banking services for the initial offering, but also equity research after the fact. And it's a two-way street. The company has to like the bank, but the bank has to like the company. So you need to make sure you meet a sufficient number of equity research analysts to find 1 or 2 or 3 or 4 or 5, depending on the size of your deal, that buy into your story and will truly support the company after the fact. Another preparatory process that is key and is typically the gating item for most deals are financial statements. And I'm sure Jason can speak to this, but the preparation of the IFRS financial statements is typically the longest pole in the tent. And when you're coming to the United States, those have to be audited under what we call Public Company Accounting Oversight Board standards. And that means there's usually a second level of review. And there's sometimes a discrepancy between that second level of review by a national office in Washington or New York or elsewhere and the local office. And that can lead to delays in the process. So keep that in mind in your planning. Obviously, there's a drafting of the IPO registration statement. That can be done typically in a month. Again, assuming that you're a new issuer and you don't already have public disclosure. And there are different forms if you're fresh going to the SEC on an F1, or if you're Canadian using MJDS on an F10. And again, that's only available if you are a seasoned issuer, you've been reporting here for 12 months or more, you have greater than 75 million in non-affiliate market cap. So, depending on, whether you qualify as a seasoned issuer and you're Canadian listed, you can use the MJDS process. That'll expedite your regulatory review. In fact, the SEC typically won't review it. They'll leave it to the Canadian provincial regulator to be the principal reviewer. So that's helpful. And they can review it as a little as a week, give you comments and get back to you. So, you're talking about maybe, 10 days of review time there. Whereas if a typical SEC process, you're talking about 8 to 12 weeks of fresh review. You have the listing application and you also have a FINRA application, but that's, typically running concurrently. So you could see there's a lot of work on the front end. In the back end, you have a longer review process, especially if you're a first-time issuer to the United States.
Thanks very much, Josh, for that thorough explanation. Very helpful. And I think that's a key question and a point of assessment that issuers think about, because while we're going to get to market conditions in a moment, but market conditions are good now, but what do they look like when all that is done? So over to you, Jamie. How do you, it's a hot market. We've heard from Nafisa. It's a hot market for some sectors. How do you provide advice to clients as to whether now is the right time?
Well, first off, thank you for having us, Stephen and Shisha. I really appreciate a chance to spend time with our friends at DLA, which we've done a number of transactions with over the years. But yes, we have a market that's open and active right now. And we look at things like the VIX, the volatility index. It's typically, I think it's trading around 16 right now. Anything above 20 becomes more uncertain in terms of the market prediction. At 30, it's pens down. So we have a VIX that's stable, and we've got a pipeline now. Finally, after a couple of years of a dearth in IPOs in the U.S., we're up 46% year over year. So we also look at a thing called M2, or money supply, which is the measure of liquid assets, cash on hand. And that's something we look at on a regular daily basis along with the VIX. So those would be two sort of measurements. And then it's obviously momentum trends and fund flow. We monitor the redemptions of mutual funds, hedge funds. That's something that we pay close attention to. And then obviously in commodities, inventories, we look at production. That's a whole different set of considerations when you're talking about taking a resource company public. But in tech, I would say it's the trend and the momentum, the sponsorship too, of who is backing the company, who are the private shareholders. That's a big consideration, is who are the financial sponsors.
Thanks, Jamie. That's all very interesting, and not something that I would have on my table to assess the volatility index, but that's very interesting to hear about. So Jason, over to you. From an accounting and audit perspective, what are the most important gaps in readiness to go public?
So thanks, Stephen, and I agree. We're often the delay. So let's talk about how to let's talk about what the gaps are so we can try and avoid that. So I would say there's really 5 big causes of this. So the first one is, are you preparing your financial statements in the right accounting framework? So lots of you out there, especially if you're a private company, may be using ASPE in Canada or a local country GAAP. if you're not from Canada. And we need those financial statements to be under IFRS or in very limited circumstances, maybe US GAAP to start. And so you really need to know what the market, what is the offering you're going to do. You need to get that accounting transition done. That is a very big exercise because you're going back to the inception of the company to do it. So if you imagine you're going back to look at any transaction that's still hitting your statements back to the inception of the company, we do this with companies all the time, and it is a massive undertaking. It alone can take 6 to 9 months, right? So that's the big first delay, is make sure you have the right accounting framework. The second thing I would say is interim financial statements. Lots of companies don't prepare them. They've never touched them. In fact, they've never even closed their books on an interim basis. They like to do it annually. It's a great way to reduce costs, but a great impediment to going public, because you need to have a basis for interim financial statements. Whether they end up in the IPO document or not, you're going to have have them prepared immediately thereafter. So you really have to be ready to go. The third one I would just say is time and resources. Many private companies, in order to reduce their G&A costs, will really keep their accounting department lean. So you have a lean accounting department. That means it takes you 4 months to close your books at year end, and it takes you another 3 months to get the audit done. So your normal cycle looks 7 months just to get an audit done annually. Obviously that doesn't work, certainly doesn't work in the IPO process, and it won't work after either. So we really say that, you need to look at the time and resources that it takes you to close your books and actually get that into the timeline that you would expect it to be as a public company well in advance of the IPO. The fourth is controls. So lots of private companies don't have many or any, and really are keeping things, again, tight from a financial department. And so we always say you want to look at those controls. We see this all the time, that companies have to disclose a material weakness in their IPO document because they didn't have any controls in place, and that has to go to the initial investors. Frankly, in certain industries, it doesn't cause any concern at all because people, frankly, the market expects it. There are other industries, especially if you're a large company, where if you're having disclosed you had big material weaknesses, that would be concerning to your investors, your underwriters, and everyone else. So really looking at your controls and making sure, based on where you are and what kind of a company you are, whether or not that's going to be a gating issue. And my final comment, acquisitions. So lots of companies will do an acquisition in the couple of years leading up to an IPO. You'll often do that to get to scale. So you'll do that. You want to do something to make yourself big enough to be interesting to investors. And we often hear from the underwriters that you just need to increase the size of the organization to get that interest. What you will find is that all those same things about needing to have financial statements done and audit done, all of those same complexities exist for the thing you're acquiring. So if it meets certain thresholds, you're going to need to include financial statements prepared for that entity. And what we find is, especially if you're acquiring only part of a company, you have to do carve-outs. They've never prepared financial statements before. That exercise alone, just for those little secondary financial statements you're including, that can take 6, 9, 12 months, depending on how bad the books and records are. And so if you are a company that has done an acquisition in the 2 years leading up to, or plans to, you really need to pull things into your planning process to really get on top of that.
Thanks, Jason, for that reminder on acquisition statements. And that doesn't go away after the IPO. It continues on. So it's good to have the practice. So Josh, we're here in Vancouver. We have cross-border practice. The US and Canadian economy, at least for now, are quite integrated. And even from a regulatory point of view, Canadian issuers have a distinct advantage of MJDS having home turf review of offering documents for US purposes. Can you just walk us through the MJDS process and when it might be the best option for a Canadian issuer?
Yeah. Again, so the MJDS system, multi-jurisdictional disclosure system, is for Canadian listed issuers who have been public for more than 12 months and have a greater than $75 million non-affiliate market cap. and would not otherwise be investment companies in the United States. If you qualify as such an issuer, then it's to your advantage to use this system because you get expedited review by the SEC for U.S. offerings. You get to use special forms that are particular to Canadian issuers that essentially allow you to use Canadian disclosure that's somewhat supplemented in a fairly de minimis way to sell securities in the United States. You do have to file periodic reports in the United States once you do list, but those reports are generally consistent with Canadian reports. So it's to your advantage to use this system. And you otherwise get to use what we refer to as foreign private issuer disclosure. So this system doesn't require quarterly reports, although based on comments from our president, no one may be required to file quarterly reports in the near future. You're permitted to use IFRS as adopted by IASB, so that's very friendly accounting for Canadian issuers. There are, a few differences or requirements in addition, including, that the audit committee must be comprised of 3 independent directors, including financial experts. But generally, it's a very friendly and easy transition system for Canadian issuers. If you don't qualify for that, again, this is not applicable to microcap companies. This is not applicable to investment companies. This is not applicable to non-reporting Canadian corporations. You can still come to the United States. You just use standard foreign private issuer disclosure forms, assuming you qualify, which is F1. And that's what every other country around the world uses. And it's very welcome. And it is still a very friendly regime. And you can still report under IFRS, which I think is people's, primary concern. There is a delay required for the redistribution of shares in Canada if you do use the F1, but that's probably a very minor price to pay for what's otherwise a fairly easy system. And I would just say one other advantage, if you have a choice between using the F1 and coming to the United States directly versus, going to MJDS and coming indirectly, is that the price, and this is more in Jamie's camp, but the price is set by the underwriters and in building a book directly through investors in the private marketing rather than by the Toronto Exchange. So if you come and you're already listed in the Toronto Exchange, the reference price from your public trading will set your US IPO price. And there's very little that the bankers can do about that. Whereas in the marketing, there's a lot more that can be done if you don't already have a public reference price.
Great point there, Josh, on the private versus MJDS side. And just for, and it's in the materials as well, there are pathways to go public directly in the United States under Canadian securities rules. There's exemption orders. There's ability to file a shelf prospectus here in Canada that replicates the F1, so to allow for trading back into the U.S. markets. So Jamie, let's talk about valuation. It comes up obviously on the pricing before a deal underwriting gets signed. It gets discussed during the beauty show with underwriters and issuers about where's my company fit in terms of valuation. You may have a market reference, and to Josh's point, or you may not, right? So how do you sort of thread that needle between the interest and reality of the marketplace and the company management who obviously think their company is extremely valuable and should only be sold at a very high price?
Yeah, it is an art and a science and a discovery process between the underwriter and the issuer. We spend a lot of time on valuation. I think it's about 80% of our time looking at comps and discounted cash flows. We look at present transactions, but the comps are really probably the most reliable, if you will. So there's an IPO discount that's understood in the market for 10%. You want a strong aftermarket, and you want to give institutional investors a lift and a good return so they'll support your future growth and financing strategies. So There are banks and underwriters that will tell companies what they want to hear when it comes to valuation. I think we like to say we tell them what they need to hear. And if you want to be able to tap capital markets going forward, you've got to price it right coming out the gate. So there are a lot of CEOs and founders, particularly, that have different notions of what their relative fair market value is. But we usually address it right up front with the preliminary valuation analysis. And it's very comprehensive. So we have the facts, we have the data, and that usually arrives at a midpoint range. And then when you go out and build a book, as Josh referenced, quite often it's a range, and the book gets billed by an anchor order, and a lead order would say, I'm good for $25 million order at the midpoint of the range. And then the book builds around that. So that's kind of the dynamic that happens. And it can be a delicate one for sure. And a lot of tension and sometimes conflict when it comes to the process. But we try to keep a level head and look at the data and more science than art, but it's a bit of both.
Love that comment about what clients need to know instead of what they want to hear, right? This is a thing that goes for all of us, lawyers and accountants, as we run through this process. So Jason, another J, financial statement staleness. So clients have prepared, gone through it rigorously, got those acquisition statements done, got the audit done, got the interims done. Now we're into a protracted review process. And what about delivering that bad news about updating financial statements?
Yeah, so I would say that the first thing that I would say about staleness is this is a great place to blame the auditors. So, you know, one of the things that happens to this process is you go from being a private company and your auditor having a lot of flexibility over things like the materiality. You know, we can do testing at one level, and suddenly you're issuing an opinion under the standards of the PCAOB, which has very prescriptive guidance on things like the materiality that's set. And so what ends up happening often, especially if your auditor gets informed late in the day that there's going to be an IPO process, is we have to go back and audit the old statements first and re-audit them under the elevated PCAOB standards. That starts with our own client acceptance and independence review. We've seen lots of circumstances where suddenly you're having a surprise change in auditor because you didn't realize that they had done something. And in fact, this happened to me, you know, in the last couple of years with somebody who wanted to go on the MJDS, and they went to their auditor and said, you know, we're listing on the MJDS, and the response back is not with us. We did this work for you, and it puts us offside on the SEC independence rules. So suddenly you're doing a change of auditor mid-year, you know. So first thing, we have to figure out if we can do the work, and then secondly, you may be auditing past periods. All of that takes time. So if we come in late, you know, we're now trying to get the audit done, and we're trying to do 2 years at once, and we get to this issue of staleness. I mean, one of the things is, assuming you've had lots of planning with your auditor and got ahead of all of that, the real issue that comes out of staleness is the comment process. And we are so fortunate that both the Canadian and US regulators have processes in place to do pre-filings. So confidential filings with them to support you in making sure that this staleness issue doesn't occur. You know, not every jurisdiction has this, and so we are very, very fortunate to have two regulators who understand the importance of this and are willing to work with you. So what I would say is, if you want to go out the gate at a certain time of the year, you need to back yourself into what is the confidential filing you need to give to them in advance with enough time for them to review it. Josh gave some very good points about the difference in timing. And I will say that is definitely also impacted by how hot the market is. We have had a very quick turnaround by the US in limited circumstances. We have a very, very long turnaround by the US when they get too hot. And so, you know, they only have this, they have the same resource constraints that the rest of us do. And so it is really important that you plan all of this. Talk to your lawyers, talk to your underwriters. They will know. what the timing is for how long it's going to take, and can help to guide you to when that confidential filing should take place. And that is really the best thing any company can do to avoid the staleness problem.
Thanks very much, Jason. Back to you, Josh. I would say up to the current Trump administration, the U.S. has been very active in corporate governance, and whether that's from the SEC or from NASDAQ or exchanges, probably now less so. I'd like you to talk about that and talk about how you see Canadian governance standards aligning with U.S. ones.
You know, I'd say it's particular to any corporation, right? So we have to consider whether we're starting with a private corporation or an already public Canadian corporation. But I mean, I think that the common factor to keep in mind is that if you're coming to the United States and you're going to be public, you need an audit committee that's fully independent with a financial expert. You know, if you're able to use either MJDS or standard FPI, you're exempted from the other domestic requirements to have independent nominating and compensation committees and majority independent board, which is quite helpful. You know, there are certain codes that you'll be required to adopt that, you know, you may or may not have if, you know, you're a public company or you're not a public company here. You know, codes of business conduct with the financial whistleblower hotline, insider trading policies that conform to U.S. standards, clawback policies. If you have a financial restatement, executives aren't entitled to, you know, keep their incentive awards and gain from that. A fair disclosure policy, so that you're not, you know, conveying material information to investors that's not otherwise given to the public, even if it's not required for foreign private issuers. We still recommend you put it in place. And then Sarbanes-Oxley, which, you know, some people have taken as bad words, actually does have some obligations for both foreign private issuers as well as domestic, including what's important is to make sure no loans are outstanding to directors or officers at the time of your first public filing in the United States. It's actually a criminal offense. And there are requirements to establish internal controls and disclosure controls, which Jason can talk about. But it's important to get that process started as soon as possible, because there are different deadlines. And even though emerging growth companies, which we mean less than 1.235 billion of revenues, aren't required to have auditors certify those for 5 years, management will be required to certify the internal controls in the second annual report. So those are challenging, and it's great to get started on those as soon as possible. And I would just say, if there are any, you know, mining companies in the room, there's some conflict minerals disclosure that is currently being contested in the United States, but you may be required to report. So just pay attention to that in advance.
Thanks very much, Josh. And then back to you, Jamie. The underwriters and agents obviously have an important role in IPO, and so do other participants, IR, marketing, both before listing and after listing. Can you share with the audience your thoughts on the roles of those participants?
Yeah, vital participants. And you know, one of the things to consider when you go public, because it's a big decision, it's costly, and it would change your life as an executive. I can tell you, you'll be spending 25–30% of your time dealing with public company matters and increased corporate governance and all those things. And you know, one of the things we advise potential new issuers is to do a test the waters, market through the street on what's called TTW, test the waters, we call it. And it's an exemption you can rely on by going in front of accredited investors and getting a gauge of the appetite, the interest, to get a sense of even preliminary val from the buy side. And so that's one way to kind of, you know, de-risk the process, if you will, knowing that there's going to be an active audience. And you know, part of that test the waters dynamic is in dealing with IR and having somebody in place well before the IPO date. You know, too many public companies go public without a resource, and it's really important for communication. And obviously, the world of social media now is entirely different, and it requires different tools and more resources in IR. So research, so we talked a little bit about research, you know, getting in front of analysts, equity analysts that are specialists in their industry or category early on in the system is critical to the pass the test, if you will. The institutional salespeople and our investment advisors look to research analysts that their good judgment and deep domain knowledge, because advisors can't be expert in every industry, and institutional salespeople, for the most part, are generalists in Canada, a little more specialized in the US. So having the analyst support internally from an underwriter, and then getting in front of the desk with a teach-in and educating the sales team early and often, I'd say, are the key things to consider.
Thanks very much, Jamie. Very helpful. So it's a whole, as you noted, it's an entire team approach to this process. I'm going to have 3 short snappers. We have only 5 minutes left for this panel. I'll have a separate question for each of you. And then I would also like to ask you, as the second part of your answer, to pass along any advice you may have for Canadian issuers thinking of going public. So, Josh, we talked a bit about some of the rule changes coming out of NASDAQ about definition of foreign private issuer, market value of listed securities, capital raising thresholds. Maybe you can just share with some thoughts on that, and then your one piece of sage advice.
I mean, say NASDAQ's trying to clean up its thinly capitalized companies, and so they're trying to ensure that new issuers have a more robust IPO offering. So they've made uniform that all issuers who are listing even on the NASDAQ capital market, which is the lowest tier, have a minimum $15 million of gross proceeds in their IPO. Stephen made reference to what is a foreign private issuer. The SEC is now looking in detail at that definition because they're concerned that a number of companies, particularly from China, are quote unquote taking advantage of our market and using the reduced regulatory standards I just spoke about instead of having the more robust domestic requirements. So I think that's unlikely to apply to Canadian issuers, but it is something that's under consideration, and we don't know where that's going to end up. My one piece of advice for Canadian issuers thinking of coming to the United States is speed. The market is open. Every week there are great deals getting done. If you are interested in accessing the markets, act quickly because the window closes and we don't know when it closes. So, start now.
Great. Thanks, Josh, for that sage advice. And then to Jason, you talked earlier about resources, having resources to prepare the statements. Then maybe you can just help the audience understand, what does the resource picture look like afterwards, and how do you get the right balance of encouraging clients to have robust internal resources versus seeking outside advice? And your piece of sage advice, please.
So I would say on the resource front, it's a different answer for everybody, but I would say what we see in terms of optimizing it, anything that's a one-off activity associated with the IPO is a great thing to send to advisors. So if you're doing a one-time gap transition, that's a great thing to send to advisors. A set of pro formas, help with your first MD&A, help with the first drafting of a set of statements, great things to send to advisors. The things that you're going to have to repeat over and over again as a public company, you should be building resources internally. So you're going to have to keep doing those statements. You're going to have to keep doing that MD&A. You need to have the people in place to be able to do those and to have the controls over it. And as Josh reminded us all, you're going to have to attest under 404A after you've done your first annual report. So you really need to put those resources in place early. The one piece of advice I would give is, if you're considering doing an IPO in the next 2 years, you need to start talking to your advisors early and come up with a game plan and strategy and map that out. As Josh said at the beginning, 1 year is not an unrealistic time frame to take this from beginning to end. And frankly, sometimes it takes longer. So if you want to be opportunistic with the market, there's lots of things you can do well in advance to get yourself ready, and you should do those things and get as many of those months of work ahead of you so that you can be opportunistic when things come up and the market's right.
Thanks very much, Jason. Jamie, we've gone through all the hard work. We filed, rung the bell, or had an opening day celebration. What about aftermarket performance and engagement? What is the importance of that? And then what piece of advice would you leave our audience today?
Yeah, I mean, it's an ongoing, sustainable at times, being a public company. Sometimes it can be frustrating, but you got to communicate. That's the key. And, you have to delineate your story. You got to explain a narrative of why you're a value proposition, why you're a growth story. Hopefully you're going public with a trajectory and you've got visibility with your revenue for the next 2 quarters, because we've seen too many small cap companies, younger companies, miss their first 2 quarters, and then they get penalized, put in the penalty box, so to speak, and have trouble getting their story out going forward and accessing capital. So it's a commitment and dedication to some of the things we talked about in terms of investor relations, attending industry conferences. We have a big annual growth conference in Boston every year, and it's focused primarily on, as the name suggests, growth in technology, healthcare, and sustainability. And we have a private company showcase. So we try to nurture these companies and give them some limelight as they think about going public. So when that day happens, they're ready and they already have relationships on the street, and they're a known entity, even though they might be a private company. So those are some of the things that we try to guide and provide. But at the end of the day, it's about performance, deliver.
So it's time now to go, right? Think of the process. Is that your advice to the?
My overriding advice, I think anyone who's considering this path, whether it be Canada or the US, is picking the right team. And this can sound self-serving for DLA, but picking good legal counsel, both for underwriter and issuers counsel, is vital. It can mean the difference between 6 to 9 months or longer. And too often our clients get caught up in the legal fees, and it comes up in our engagement agreements, because issuers pay for underwriters counsel. And there's lots of issuers that think they can be penny wise, pound foolish, if you will, by picking less experienced counsel or firms that don't have a cross-border practice. For example, if you're considering some kind of dual list, or obviously a US path. So that's where firms that have that presence in both jurisdictions can really make a difference in anything cross-border, obviously.
Thanks, Jamie. So that concludes our first formal part of the panel, but we want to have our panelists stick around for a few more minutes to entertain some questions, and both here on the floor, or if we have none online. Okay. So everyone here in the room has the benefit of a bit more time with questions, if you have any.
For Jamie, is whether you would see companies changing their corporate counsel or adding new counsel specifically for the IPO process that may be different from the corporate counsel they've had to date?
Yeah, most certainly. And quite often we see a transition in the CFO seat for someone who's got really active experience on NASDAQ listing. CFO, they're hard to find in Vancouver, but quite often it's upgrade in counsel and an upgrade of the CFO position, that somebody who's got sophisticated capital markets experience and relationships.
I would just add, sometimes if you're a Canadian corporation, you're coming to the United States, you need to add US securities counsel. So it can be a complementary addition.
Yeah, hi. Just from a high level on the capital markets and investor interest in dual listing. And from a sector perspective, Canada seems to be really well endowed with mineral resource plays right now. But for the rest of other companies that are outside of mineral, what can you give us in terms of market experience right now for tech, clean tech, industrial, things like that?
Well, that's coming from someone who knows how to do a dual list. Darren Seed and I took a Westport dual list in the US, God, I don't know, years ago, but it was a great case study. So yeah, we are seeing some renewed interest, but Canada is always going to be a resource-driven market. I mean, it's Oil and gas, 16% of the GDP. Mining and metals is having a moment right now. We've got terrific metal prices and all sorts of Canadians are recognized as leaders in that industry globally. So we're having success with uranium, dual list. We did obviously some of the first Bitcoin miners have dual list successfully. We've led just about every dual list that was done in that sector. So that continues to be a capital intensive sector, if you will, and it's still open. And even though it's highly volatile, but we are seeing, as Nafisa said at the beginning, a lot of interest in all things digital assets. You might have heard the acronym DAT, where Josh and I were talking about that earlier, digital asset treasury plays that we don't quite know where it's all going to go because a lot of it hasn't been put to work. There's companies issuing from treasury to buy digital assets and they're trading at a premium, which kind of scratch your head how long it's going to last. But there's a lot of SPAC activity there, reverse mergers. So we'll see a lot of that capital has not yet been deployed. So it remains to be seen how that all plays out.
I would just add that if you're private in Canada and you're thinking about a single listing in the United States versus a dual listing in Canada and the US, I would think strongly about a single listing in the United States to concentrate your trading so that it's not dispersed and you have more in a single market, or a step function and starting in sort of TSXV and then coming to NASDAQ as the company's growing, which allows you to raise capital. And we were talking earlier about TSXV's complementary fundraising services that allows you to grow the company over time and then maturing and coming to NASDAQ.
Sorry, and maybe just one more thing. I mean, the one place I would say that we've certainly seen an overwhelming amount of liquidity in the US versus Canada is the life sciences space. It's a completely different market. We can't even describe the difference in trying to get, so as long as you can get somebody interested, you can raise money in the US. It's really much more difficult in Canada.
So I think that, we should be undervaluing the value of that Canadian market. I think if you are a company that is organized, right, has the right team, is putting in the work to make sure you have the right package together, it's a really great platform that allows liquidity at a much earlier stage. We know for a lot of Canadian companies, right, we don't have as deep pool of investors who are ready to try to transfer, right? And it's harder sometimes to get to the US at an earlier stage, right? So we do have access to this vibrant benefit community that I don't totally discount as well, right? Because it can be a great stepping stone and a great place to be, not just. So I think if you are organized, you package your company properly, there's a lot of great resources in Canada that can really set you up well and give you liquidity and access to capital sometimes that as a private company you may not have access. I think there's a lot of people here who probably cut our teeth in that for a very long time, right? And have seen those companies grow and manage that trajectory, right? So I think when you are larger, you're in certain sectors here at that stage, definitely the single US listing might be the way to go. But I think for a lot of those companies that early mid stage, there's a real benefit to that Canadian path and the dual listing path. But you've got to make sure you're doing it. You're prepared to do it and prepared to navigate what it'll mean having stock prices on both sides.
Right. Thanks, Nafisa. And we're going to be delving into that in our next panel about single jump or 1 + 1 = 3. I would call it a dynamic. We have time for one more question. Barbara, sorry.
Through the OTC markets and maybe commenting on what that is and a big difference in terms of the compliance system in the US. Maybe you can just comment on that.
So Barbara's referencing a level 1 ADR, which has fewer reporting obligations, really no reporting obligations if you're a reporting company in Canada. So it's a low cost way to permit trading in the United States on the over-the-counter market, very low legal fees to start up, maybe $100,000, $200,000 to get, on file, but it does not allow you to sell securities in the United States. So that is the big downside. If you want to sell securities, you have to upgrade to what's called a level 3 ADR, level 3 program. So that will allow you to sell securities in the United States. And then there's a level 2 program where you can just list your securities on exchange, but again, without selling. So my recommendation is, if you're going to do it, go for the U.S. offering and listing in a level 3 program, but an OTC trading capacity could be a baby step.
Thanks very much. With that, we're going to take a break. We're just a bit over time, so I'm going to exercise my discretion. Instead of a 10-minute break, you have a 5-minute break, and we'll resume in about 5 minutes. Yeah.
All right. So I heard lots of interesting conversations, lots of, meeting lots of people meeting new people, seeing old friends. And that was a lot of what we wanted to do with this event, right? Was be able to get business leaders, innovators, all the stakeholders that really make up our capital markets community here in Vancouver together to have some of these discussions and to see how we can grow the space together. So I want to introduce our second panel here. Stephen Wortley is going to moderate again, and I'll turn it over to him to introduce our panelists to delve into some of those issues we were talking about right at the end around, deciding, do you list on one side of the border, both sides of the border, what's the right approach? And it's going to be different for every company. And I'll turn it over to Stephen.
All right, well, we're on to panel number 2. And I think we set the stage from the last panel on a little interchange on Canada versus US. So we're going to delve more into it in this panel. So with me to my immediate left and coming office just down the I-5, right, to Vancouver, coming up the I-5 to Vancouver is Patrick O'Malley, a partner in our US Capital Markets Group. Jamie Brown was on our first panel, so don't need to reintroduce him. And we have Andrew Hall from NASDAQ joining us virtually today, and will be delivering very interesting insights on opportunities for Canadian issuers in the NASDAQ market. And we have the full team from TSX and TSX Venture. We have Andy Creech here in our offices, and I think most of us know Andy, who are involved with capital markets here in Vancouver. Andy is an incredible resource and super helpful for issuers to get their deals done. And while from the TSX, Chris Burkett has actually officed here in Vancouver, so on the ground support as issuers navigate through the very tried and true graduation plan from CPC to Venture to TSX main board. So they're all officed here, and they're all here to help issuers as they grow their business. But we're going to start where this is a U.S. listing session. So we'll start with Patrick, my U.S. partner. Lots of different ways to go public into the U.S. Some of them are dealt with in our materials. Over to you, Patrick, to talk about the pathways to go public and the pros and cons, perhaps, of them.
Sure. I think Josh probably touched on a few of these in the first panel, but everyone's familiar with your traditional IPO, which would be your listing in the U.S., preferably on NASDAQ, which is far better than the NYSE. Andy can attest to that. That's, in my view, probably the preferable way of accessing the U.S. capital markets. It might not be available to all companies, but again, tried and true method. Everyone's very familiar with it. Investors are very familiar with it. You have a very broad investor base who are comfortable with a U.S. IPO. There's 2 ways to do it here. As Josh mentioned, you could just do a single list in the U.S. or dual list. If you're an existing Canadian issuer, you can rely on that MJDS framework that he talked about to do a U.S. IPO, which is a fairly easy process, frankly. Traditional U.S. IPO is a little bit lengthier, as Jason also talked about. It could be a full year or even longer. But really from start org meeting to completion is about 4 to 6 months. The next method would probably be a direct listing, which would just be directly listing on NASDAQ or the NYSE. Not very common. The first one was in 2018, which was Spotify. There have not been very many since then. Usually, it's not preferable because you're not actually creating that liquidity event with the actual IPO. Liquidity is just coming through your existing shareholders. So it can be beneficial because you're getting a true market reaction to the company stock, but rather than the bank building that book and price, but frankly, not optimal. After that, there's a reverse merger into a public shell. Usually it's a life sciences course where you have a failed public company, which is then essentially merging or acquiring a US private company, Canadian private company, who's going public via that method. Similar to a direct listing in terms of you're basically listing anew with whichever stock exchange you choose, can be paired with a public offering on the back end or a private placement during that interim period. Again, not as common. Usually if a company has a path to a direct IPO, that's the method they're going to take. Really, it's a company that might not have the interest of investors because they don't have the story, because they don't have the predictability on the next couple of quarters that Jamie mentioned, that you might take that route. Last, which Josh mentioned, is gaining steam again after 2020, 2021, is the de-SPAC process. Again, it's more popular right now. I think it's in vogue. There's reasons to do it even if you have a traditional IPO path. That said, there's definitely some drawbacks to it because you have a less predictability in terms of your exit stockholder base. You have a built-in valuation of the company, which is nice. But again, I think it's probably something that you're not going to see a whole lot of, even though it's in vogue right now.
Thanks very much, Patrick. There's a full smorgasbord of opportunities there. And I think for the Canadian audience, we'll recognize, de-SPAC is the US version of a qualifying transaction to CPC. So there's lots of parallels between the Canadian and US markets, and it's not an entirely foreign land when it comes to transactions. So then over to Jamie, if we're going to talk about a dual listing offering, and in preparation for today, I think we talked about one of your successes. How do you market to both Canadian and US institutions to build that book, to build the demand for a successful offering?
Yeah, well, I think first question you need to ask is the threshold and institutional relevancy. US is very different in terms of the definition of small cap. It's considered 3 billion as a small cap company in the US. So, average IPO this year has been around $2 to $3 billion in market cap in the US. So that's something to take into consideration when you're even thinking about going to the US. And then obviously, there's other considerations in terms of being a reporting issuer. Just the very costs in the US are greater than Canada. So you want to go at the right time with a relevant market cap and with a firm that has a cross-border presence that can deliver, you'd hope, US equity research analyst and specialized sales. So that's a roadshow that happens. You hope to get a good hit rate. Probably takes a week out of your life. You go to Boston, New York, Toronto. Quite often we take companies from North America to London. We have big distribution, 2,200 accounts globally. So it's a function of finding the right market cap, the right industry, the right geography. Global firms, the bulge brackets, main bank-owned dealers, for the most part, have a U.S. presence. We're fairly integrated cross-border. For us, we can get a SWAT team going because we have a lot of benefits of a bulge bracket firm, but boutique-like focus. So that's a key for us as a competitive advantage. Be able to mobilize sales force in those geographies and getting the hit rate, having things like an annual conference where you have 75% of the companies from the US, the balance from Australia, UK, Canada, and it's unifying sales team experience that we use to leverage when we're marketing a deal. So it's increasingly a global world and streamlined streamlined jurisdiction is great.
Apologies.
And I think North America has a huge advantage with things like the MJDS.
Thanks very much, Jamie. So Andrew. There you are, Andrew. Yes.
Good. Thank you. Do you hear me okay, Stephen?
Yeah, you're perfect, and perfect. So Andrew is the senior managing director of NASDAQ New Listings. In prepping for today, NASDAQ is very active globally, including in Canada. There is a NASDAQ New Listing rep, I believe, in California that services this part of the continent. So NASDAQ is very much interested in Canadian issuers, and is with us today to talk about opportunities for them. So it's a competitive world out there, Andy. Needless to say that exchanges are competing for interesting opportunities, which is good for issuers. It gives issuers a choice. So when a Canadian issuer comes to you and to NASDAQ, what are the top reasons that you articulate for thinking about coming to the United States and to NASDAQ? And are there any misconceptions that you confront?
Yeah, no, thanks, Stephen, and thanks everyone for having me. Sorry I couldn't be there in person. I'm here on East Coast time, but I guess first is why list in the U.S. and I think in the bulletin there might be a few slides that I'll speak to. But the U.S. is by far the deepest pool of investor capital in the world. The U.S. has 27% of the world GDP, which is, there's a page there in the upper right that looks at the GDPs of some of the larger entities. But 50% of the investor capital back in January of 2022, it was 60% of the investor capital, with Canada back at 2.5%. So this is looking at the total world capitalization of the world. 60% resided in the US in January of 2022. As we move forward to just last month in August, it was 50% in the US versus 3% in Canada. Why the shift downward was really because there was a rally in Japanese and Chinese equities that took more of a share. So certainly that's the draw, is the benefit of this huge investor base that exists in the US, not only just for healthcare, but for mining, for really all sectors. And what we've seen is, which is kind of a third slide in the packet, we've looked at companies that have added TSXV companies that have added the US listing on NASDAQ from 95 to just early this year. So it's a pretty good pool of data. And what we've seen is that over-the-counter volume, so most TSXV companies will have this over-the-counter trading that naturally develops. It's just a US market will develop where a US investor wants to buy in their own time zone, their own currency, and they go to FINRA and they get this symbol with the F at the end. Sometimes companies take a step further and pay for the QB or QX designation. But what we've seen is post-listing, that volume go up 10x, and the Canadian volume increases as well. So it's not a cannibalization. And of this huge swath of data, about 2/3 of these companies listed without an offering. So just used a 40F, did a wrap around their annual report and registered and listed and hung their shingle out that they're a NASDAQ listed. The other third had an offering component. So maybe they used an F10, wrap around a Canadian shelf and listed that way with an offering component with both in Canada and the US. The most glaring in this page is that the institutional ownership has gone up significantly, where a company that was 250 million market cap maybe had 10, 11 institutional investors, that going up into the 40s. And for whatever reason, these US institutions, they want to have the US listing. You would think that they're experienced enough to go buy in the Canadian market or build on the over-the-counter, but they really want that US listing. I think you're competing for investor dollars just like you compete for customers, and it just makes them a little bit easier, less restrictive to have that US listing. And then typically you add 2 more sell-side research analysts that wanted you to be US listed. in pivoting to why NASDAQ versus NYSE or NYSE American, I will say it is a dogfight between NASDAQ and the NYSE primary for listings. One page in the packet looks at the aggregate market cap for the two exchanges, NASDAQ versus NYSE primary. And we're the new exchange. We're a couple decades old. They've been around since the guys with the colonial hats, but we just hit parity just last month in terms of aggregate market cap for US domestic issuers. And that's really, we've done well with new listings, but the bigger story is companies like NVIDIA and Microsoft being able to add another $1 trillion in market cap within a short amount of time. And then the other slide kind of just compares when you look at the US market, is the market capitalization of the various countries back in September of 2024 to just last month. One benefit of NASDAQ over our competitor is that we don't charge for listing of additional shares. For example, the NYSE American will charge 2 cents per share for listing of additional shares. So we just have one all-inclusive annual listing fee, which is a little bit less than NYSE primary, a little bit more than NYSE American, but that's it. You pay that one annual fee and that's it. The NYSE American and the NYSE charges for listing of additional shares, and the MX does 2 cents per share. So if you issue out 3 million shares and you're listed there, you get a bill for $60K. You issue out 2 million shares, it's $40K in addition to the annual fee that you already pay. So if you're a company that's going to do some share issuances, that can be a high cost of capital. In terms of misconceptions, I know I've been running pretty long, is the misconception is that it's difficult, that filing with the SEC is a huge bear. As panelists have indicated already, you do have multi-jurisdictional filing status, MJDS, and if you're over the 75 million in the market value, the public float US, those registrations, either the 40F or F10, are typically not reviewed by the SEC. So you can file them, and then within a couple days they can go effective. So it is a quick turn. You can keep IFRS accounting, you can keep Canadian dollars. So there is a lot of benefits of being a foreign filer, and particular benefits to Canadian issuers that other international companies don't get in terms of the SEC review. The other misconception, or the surprise I should say, is that the high cost of directors and officers insurance. We're bigger litigators here in the US, and your D&O insurance might go up 4 to 5x. So that's just something that you have to consider. And it's a cost benefit analysis. That by far is the biggest cost, is that increase in D&O premium. If you're doing an offering component with the listing, it's going to be higher than if you're just registering and listing, but rates have gone down, and that's something that you'd probably want to shop if you're adding the US listing. And then the last piece on misconceptions is some issuers might think that by listing in the US, you're creating almost a different security. No, it's ordinary stock, it's fungible. You're just creating another marketplace. I can buy you on the TSX and a second later sell you in the US market on NASDAQ. And we have fragmentation, as in Canada, you have the Chi-X, which we acquired, but you've got Neo and Triact and Omega. They trade the Canadian stock, but they don't have necessarily a listings franchise. We have that as well, where there's other exchanges that trade, IEX or BATS or Members Exchange or Miami Exchange or Long-Term Stock Exchange, but the NASDAQ and the NYSE are the two powerhouses.
Thanks very much, Andy. And I just wanted to remind the audience that all the presenter materials start at page 164 of this book. So those slides that Andy was referring to are in here, and so are slides from the TMX group and from Canaccord. And Andy, I really appreciate that comment about the 1 + 1 = 3, the boosting trading liquidity on both markets. I think that's a great point. So that's a great segue actually to ask Chris Burkett, president of TSX Listings, about the role that the TSX group or TMX group plays in servicing senior issuers and delivering a value proposition for them to stay in Canada while perhaps entertaining dual listing strategies in the US.
Is this one working? There we go. Thank you also for having me here. I largely agree with a lot of everything that Andrew said with respect to the increased liquidity when you get an interlisting. So it becomes why stay in Canada. There's a few reasons that I would suggest. One is the concept that ignoring the home market is something you need to be a little bit careful of. Where you've got a brand being built in a country, to ignore that country in terms of raising capital and allowing investors from that country to invest in you is something that you really need to consider before you go international without maintaining some kind of domestic listing. The other thing I think is an important consideration is index inclusion. Whether you're ready now for an index or in the future, there is specific parameters that you have to meet to become a constituent in an index. So, for example, if you're a Canadian incorporated company that just goes lists in the States, there's a good chance that you would never be eligible for a U.S. index. So to maintain a Canadian listing, you would be able to have an index representation there. So there's a couple things there that are probably worth thinking about. I think when it comes to Canada versus the States, I think Andrew's already sort of touched on it a little bit. We do hear that the Canadian regulators are a little potentially faster, though I think the SEC is catching up. And I think they're a little bit more nimble. And the reason I say that is because we've been first to the market with a few different things. And whether it's ETFs, any ETFs 35 years ago, or crypto ETFs that we were a couple of years ahead of the States on that one, then I think it's probably worth considering that. Look, there's no question, and I am hesitating to make the joke that I've got Big Brother over my shoulder. There's no question that it is the U.S. is a very deep pool of capital, serves really large companies very well. We do have some expertise in the small and medium-sized enterprise market, and I think it's a good idea maybe if you're not at that $3 billion level yet that Jamie referred to, then maybe it's a good idea to have a market that is more accustomed to servicing companies that aren't there yet.
And I should add the Canadian style bought deal, a unique instrument that you can't really avail yourself very easily in the US, but it's done frequently in Canada, and something we're very accustomed to. So keeping that Canadian listing and filing in your primary jurisdiction with continuous disclosure allows us underwriters to bid companies, use our balance sheet, and resell overnight. And we do the due diligence after. It's a Canadian entity. It's strange how we do it because in the U.S. they do everything up front. It's very prescriptive rather. So we do it different in Canada, and the bought deal is a great follow-on financing where we take the market risk and resell the next morning. Overnight bought deal.
Great point.
The other thing I'll say is that the TSX, TSXV with the NASDAQ listing or even the NYC listing is a complement. We don't ever advise for you to leave your TSX, TSXV listing. You want to keep that. You don't want to alienate that investor base. This is just adding an additional listing in the U.S.
Great point. So it's bringing the best of both worlds. And from a practitioner's point of view, the short form offering bought deal process is a very unique Canadian product. It's the way capital is raised. It builds upon a continuous disclosure record that allows for these serious commitments to be made. So sort of switching gears a bit to Andy Creech, Managing Director of Listings of TSX Venture. I think many of the DLA Canadian lawyers here have benefited from the progression of issuers that participate in a QT on a CPC transaction, that go to the TSX and get listed, and maybe even the next week, if they meet listing standards, move right up to the TSX main board, get seasoned, and then perhaps enter on a dual listing basis the U.S. markets. So Andy, how do you articulate the advantages? And is that what I just mentioned? Is that something that really resonates with a new listing audience in Canada? That advantage, the graduation, the progression, moving up market.
Yeah, for sure. Thanks, Stephen. And hi, everybody. Thanks for having us here today. So one thing I just want to follow on from the earlier session, Jason mentioned it. We do pre-files as well. So when you're thinking about it early in the process, please feel free to come by. We can talk about cap structure. Sometimes we have people come in, they're entrepreneurs, they want to do a transaction. They don't know people in the public realm. We can put them in contact with some frequent filers, if you will, in terms of serial venture capitalists and whatnot, and or put them in contact with expert advisors like DLA and others. So with that, just in terms of TSX Venture stepping stone kind of concept, we do have an active presence in the US. We do US roadshows down there through multiple cities. We have staff down there looking for entrepreneurs that are looking to access the public capital markets. And when we go down there and we say, hey, you want to go public, right? Yes, we do. And they said, like, come up to the TSX Venture. They're like, what? What's that? So there's an educational process to that. And after that educational process, they're really interested in it because it's a micro cap from what Andrew's dealing with NASDAQ perspective there. But it's an excellent growth platform. So when a company lists, a U.S. company comes up here, it's a well-trodden path. We've had over 100 issuers listed from the US. And then in terms of graduations up to TSX, since 2000, we've had 776 graduations from venture to TSX. 40% of those are tech issuers. And so as it relates to venture, access to capital, you become a public company, you can use your securities to do a roll-up acquisition strategy, learn how to run a public company on the venture exchange. We have fairly prescriptive rules. We have growth accelerator programs out there where we have people on our teams that help educate our issuers around governance, disclosure, investor relations, steps to graduation. So after they execute on their business plan for a while and grow their business, then they go through the graduation process. And to go to back to the US side of things, then, one thing to consider, listing on TSX Venture, it's generally a little bit cheaper than listing down in the States. As Andrew had pointed out, the D&O insurance, it's lower litigation risk listing in Canada as you're that smaller issuer, developing your business, establishing those routes. We do have 200 cross-listed issuers between NASDAQ and NYSE. So and we see that enhanced liquidity as well when you are dual listed. You gain a stronger profile when you do go south. So in Canada, just one thing to point out, $1 billion tech issuer in Canada, you're number 21 on the list in terms of eyeballs on your stock. In the States, you're about 330. So you usually get better analyst coverage while you're listed with the TSX Venture on that side of things because you're a bigger fish in a smaller pond. But no doubt, when you're talking about any U.S. entrepreneur, the end game for them is definitely to list in 6 to 8 years back down on NASDAQ NYSE.
Thanks, Andy, for that fulsome explanation. I want to now go back to the two Andys and to Chris about what Canadian listed companies are best suited to go dual list in NASDAQ, or what Canadian companies that are private should think about going directly to NASDAQ. So Josh's point earlier, what are the key factors, size, sector, investor base? What are the ingredients for a direct listing from Canada or a dual listing from Canada? Maybe I'll start with Andrew from NASDAQ.
Sure. Yeah. So I think if you're private and you're looking to add the listing, you want to look at your investor base. Where does your investor base reside? If you've got a fair percentage in the U.S., then maybe it makes sense to list in the U.S. initially. Also, where's your customer base, your operations, your people? If that percentage is there, then maybe it makes sense to list in the U.S. Also, as a factor is if you're going to Canadian list first and then add the U.S. listing, are you going to qualify as a foreign filer, right? If your shareholder base is going to be over 50%, you fail A, and then also your majority of your assets are in the U.S. or you're headquartered in the U.S. or the majority of your officers and directors are in the U.S., you're going to have to file as a U.S. GAAP filer anyway. So that would be a consideration. If you're a Canadian issuer listed on the TSXV or the TSX, I think that it's really great to have that multi-jurisdictional filing status. And you need to have 75 million in the market value of the public float. So I think, accounting for insiders, maybe it's about 100 million market cap US, roughly. Maybe that's the time, if you're performing well and your story's going to resonate in the US and you're going to be rewarded for that listing, that's maybe when you look to add the dual listing.
Thank you very much. Over to Chris and Andy.
Okay. Yeah, so for the vast majority of Canadian companies, it's definitely better to establish the base in the domestic market. Chris alluded to it earlier. You need to achieve scale and relevance first before seeking that US listings. It's just, if you're going down pre-rev and with a prototype and not much business to it, you're going to get lost in the noise for sure. And our ecosystem's designed to support those types of issuers, get a couple rounds of financing in, get the management team up to scale. We have seen a few bypassers. That's, Canadian companies skip the Canadian listing, go straight to a US listing. And those issuers that have bypassed since 2019 have had severe challenges with their average share price declining like over 80%, average market cap decreasing over 40% since their listing. And that's like a listing, I'm talking more like venture size companies here. Like an average listing size financing for us is $2 to $10 million generally. So these issuers listed with like a $15 million raise. So not altogether that high, right? And because of that, 70% of those companies are struggling to comply with their ongoing listing requirements there and having to do reverse splits and consolidate their stocks to maintain records there. So the other thing there is just Canadian companies would also consider cost. Everybody's cost conscious these days. Generally, to get transactions done up here, it's cheaper, and you got Canadian dollars at a tremendous discount to the US, so you can get excellent legal advice and accounting advice at a 40% discount.
Thank you. Over to Chris.
In an effort, maybe it's me for sure. I'll try my best not to duplicate everything that's been said, because I think there's been a lot of points raised already that are worth noting. To me, it's large, well-established issuers that already have set down roots, have processes in place to make sure that they're going to be compliant and that they're going to be more willing to accept the compliance costs, the increased compliance costs that exists in the US. Maybe I will touch on the MJDS thing, because we've actually seen that, and we've seen it with some pretty significant success. And in 2021, everybody knows we listed a lot of tech companies. A number of them stayed Canadian only for exactly 12 months and a day. And then you saw Lightspeed, Nuvei, I think Docebo was also another one. They all went south, and they all basically were quite successful in going down to the States and tapping that deeper pool of capital that we keep hearing is global. But when you see when you use Andrew's math about the institutional investors increasing when you start a US listing, there is a compelling story there for issuers that do want to go down to the States. But again, I think making use of MJDS, being big enough to make use of it and accept the compliance costs, that's probably when it's best to go.
Thank you so much. Back to Patrick. I want to talk about aligning Canadian and US disclosure standards. Getting eyes on that is of critical importance. What are some of the issues around that alignment? Is it an easy task, a difficult task? And what role can you play in helping issuers with that?
Well, hopefully it's very easy. The first thing you need to look at, whether or not you're already listed in Canada, is what Andrew alluded to, is would you qualify as a foreign private issuer? Meaning, where's your stockholder base, where are your assets, where are your headquarters, where are your D&O? Assuming you qualify for that, then the next step is, as Chris was talking about, are you MJDS eligible, which is a reason to list for 12 months and a day, because If you are an MJDS eligible company, really, really easy. You're almost solely relying on it. As Josh mentioned, there might be some superficial additional disclosure that's required in your 40F. Otherwise, very straightforward. Mining companies has largely been aligned over the years, but there might be some slight differences there. If you're not MJDS eligible, your 20F is going to be a little bit more fulsome. And if you're not a foreign private issuer, you got a lot of issues and you're going to have to talk to KPMG because that's going to be the biggest issue.
Perfect. And Jason's thanking you for that comment. So, so Jamie, just speaking of cross-border listings, what are the ones that sustain investor interest and which are the ones that struggle? And then think about maintenance standards, delisting, all that ugly thing. So what is the success story look like? What type of issuer is the one that goes to the US and maintains that success?
Yeah, I think we're good at growth and innovation. So those companies that demonstrate those qualities with, even I'd just go as far as say hyper growth are the ones that excite the marketplace, and typically they have strong IP and technology or a great molecule in life science and have captured the imagination of institutional investors. Very specialized in the US. I think I referred to in the previous panel that how deep the domain knowledge is in that market. So the companies that can articulate their value proposition to the street, to the research analysts are really a critical part of the whole ecosystem and the buy side. And those companies that are out there constantly doing non-deal roadshows, getting their story out, tend to obviously have better liquidity, better profile, greater access to capital. So it's not just a one-time event. You get public and you can just pick up the phone and call an underwriter for a follow-on offering. You need to be out there in a consistent manner, day in, day out, talking to shareholders, buy-side portfolio managers, retail investors, attend the conferences, work the relationships on the street. And, it's a big commitment.
Thanks, Jamie. So then moving back to Andrew and the sorts of services that NASDAQ provides issuers on a post-listing basis in the first year of being a public company. Can you touch upon that for this audience?
Yeah, I mean, the US markets are super competitive, or a unique country where you have two dominant exchanges. As I said, at market cap parity, if you look at IPOs, we're fighting for every IPO. We've done well in terms of our win rate over the last 6 years, but in terms of proceeds raised, we're neck and neck in terms of looking at the aggregate offerings of private to public IPOs that list on NASDAQ or the NYSE. So with that, we have to be competitive from a service standpoint. Okay, what do you get out of your listing? It's not just pay your listing fee and that's all. So we do have a platform. We have logins. You can do institutional targeting, trading analysis, level 2 quotes, real time. So that's a service that we provide on the IR side. We also have a market intelligence area where they reach out proactively and provide reports each day. They're there on a reactive basis. They're industry expert in their various fields. So that's a support to an issuer. They're there just to serve the listed company. They're not a regulatory or compliance person. They're there to help and navigate that trading, what's going on, who's trading on the broker, who's selling, and maybe give you some institute into institutional ownership. And then also we have the fun things. You can, of course, ring the bell and celebrate that listing either at the time of listing or sometime thereafter or a milestone. We have some nice event space where you can have your investor days and company events, on-site caterer. And then we even have a small group PR team that will do some interviews, and they will customize interviews, friendly interviews to really get out your story, and we push it out through our network. So from a competitive standpoint, we're there competing for listings, and then we provide ongoing market support.
And you can get your face on the billboard in Times Square. It's quite something.
Yeah. So yeah, we have that the market site there in Midtown, which is
Fantastic.
the front of Times Square.
So I'm getting signaled that we're out of time, but I wanted to have a few short snappers because I think some of the questions that we had thought we would address, I think have already been answered. So Patrick, and I get this asked all the time in Canada. So I'd like to hear your answer from a US perspective, you know, reverse merger, de-SPAC, IPO, like how do you guide clients to make the right choice?
What are your goals? Are you looking to raise capital? Are you looking to generate liquidity? You're looking for the highest possible valuation. What's your story? Are you a growth company or do you have predictable earnings? Do you have historical earnings? You know, what does that look like? Again, I think a traditional IPO, be it already a listed company in Canada or new listing, most familiar story, if you're already listed in Canada, it makes a direct listing a lot easier in the US. So that's kind of usually where I would steer clients, unless you're have a different story, in which case it might be that a de-SPAC or a reverse merger makes more sense to you. But the answer is, you know, what are your goals and what's your story? Those are the first things you need to talk about, the first things you need to figure out.
Perfect. And Jamie, over to you. You're a short snapper. Are there particular deal structures, and the markets are up now, but are there particular deal structures to protect issuers on cross-border offerings?
I would say when the market opens and closes, and in volatile times, we talked about the VIX and money supply and what the Fed is going to do tomorrow. But I would say there's one instrument that has been widely adopted by companies that are capital intensive. You know, quite often technology, innovation, life sciences, they're burning cash. You know, their commercialization path is a ways out, and the at-the-market instrument has become a very useful tool for CFOs to be able to issue shares from Treasury on a daily basis in the market. So it's a lower cost of capital. It can be done as a percentage of your daily volume. And one of the advantages is you don't have to disclose until your quarter end. Again, based on continuous disclosure, you have to file a base shelf, but it allows you to issue from Treasury during tough market conditions. Because quite often, you know, the big deals just won't happen in a closed market. The company still needs to fund its operations, so they can take advantage of this tool called at the market.
Perfect. Thanks, Jamie. And then to Andy and Chris, respectively. What are the badges of common badges of issuers that are ready to move from venture to TSX? I guess that's the first part. And the second part is for the common badges of Canadian issuers on the TSX main board, thinking of a dual list. So maybe we'll talk to the TSX V perspective first.
Sure. So in terms of like, I could break it down into two, kind of like there's operational sort of milestones, and then there's the governance milestones. And it's been alluded to before on the governance side of things. As venture issuers grow, they usually start with a board of directors, bring in more enhanced directors over time, rotate through. Well, like when Vital Hub graduated to TSX, their CEO was really excited, and they said, look, it was our really strong management team, it's our strong board of directors, and our strong technical base that they grew while on venture and then listed on TSX. And then operational, it's largely driven by access to capital. Most people around the world that I've ever spoke to about a listing is, if you can show me access to capital and liquidity, I'll come list. So for venture companies, average financing size is about $4 million. TSX average financing size is about $40 million. So it depends what kind of pool of capital you're looking to grow the business. Like I said, start small in the venture and then graduate to TSX and then interlist with the US side.
And then just add on, it's working now. Just add on to what Andy said, because everything he said was true about strong management team. I think a couple of things I'd add on. I think Jamie alluded to it as a strong communication strategy and investor relations strategy to let people know what you're doing. And then that coupled with acting like a big board company. There's venture carve-outs in Canada, and Andrew, you probably won't be aware of this, but there's venture carve-outs in Canada we see the successful graduates being the ones that have tried to not rely on the carve-outs and act like a senior listing. And so when they do move, it's not night and day, moving from the 120-day reporting to the 90-day reporting, et cetera, et cetera, et cetera. And the only other final point that I'd make is the timing. We can arrange the timing so that it all sort of comes together at once. There is value in completing a raise on the listing, on the move from the junior market to the senior market, because you can have a conditional approval letter in hand and actually market with that in hand, and make a bit of a bigger splash when the move comes.
Thank you so much. Well, that concludes our second panel. I want to thank our panelists. But before we move on to the reception and the networking, is there any questions from the audience now with respect to this group? Yes.
So very educational panel, very entertaining panel with everyone kind of competing on which exchange to go to. So that's fantastic. So our story, Brad DeVille, CEO of Greenland Renewables, we listed on the TSXV 6 years ago. We graduated within 18 months to the TSX. We were on a trajectory to dual list to NASDAQ, and then it didn't happen. So I've heard some mixed messages. Jamie said small cap today is 3 billion market cap. You can move up when you're 75 million, according to MJDS, very convenient acronym. How realistic is that? I mean, is that truly any success stories today with that 75 million US market cap, or do you really have to be 3 billion?
I think you want to be 500 million market cap, to be honest. And I've spent 10 years in the US capital markets and the balance of my career in Canada with different zero behind the figures in the US. And I just, it's the overall cost. That's an underwriter's view. And I'm sure Andy and Andrew have other views, and Chris. But I think just the size and magnitude to avail yourself of the MJDS, you need that public float. So that's the test. But in reality, in terms of institutional relevance for at least what our audience is, the institutional investor in the US, it's a $500 million proposition market cap.
I think it becomes really challenging when you're raising smaller amounts of money, because the investor base isn't, I mean, you're getting a different tier of investors, and they're often looking at different things than what's the long-term prospects of the company. So when you're raising less than $50 million, it's probably not the right path.
Agreed.
Thanks, Patrick. And over to Andrew from NASDAQ.
Yeah, I mean, if we look at the dual listings so far this year, we've had a few, and these are mainly mining companies, a few billion and a few hundred million. I would say there was one just recently that listed about 160 million. There's one listing on Thursday that's 100 million market cap. So in that pool of data that I showed from the mid 90s to just early this year, kind of the median average was about 300 million in market cap. So the Canadian market, as Andy and Chris alluded, there's a lot of companies that are in the micro cap or smaller end of the small cap space where you're only a few hundred million in market cap, and those are the companies that look to cross lists, because that really is the universe that is the Canadian market.
Just if I can add on quickly, a medium-sized company, the median market cap on TSX is only 156 million. And the other thing that I think is worth noting is the 75 million you quoted, that is the bar for MJDS. That's quite an old instrument, and I feel like you could add a zero onto that pretty easily, to be honest, and maybe that's a bit more of an indicator.
Thank you so much. So we're out of time, and I know there's some questions online, so we're going to try to collect those and then triage them and post answers on our post-meeting report. And for everyone who is joining us virtually, we will make this book available online to download. Over to Nafisa.
So thank you everyone so much. I know it's a lot of information, a lot of discussion and information. Just one more tidbit. In the materials, another thing that we've included is our Global M&A Intelligence Report for 2025. I know a lot of these conversations have surrounded IPOs, initial listings, capital raising, but as we heard, that all comes along with M&A activity as well. And so in here, you'll find a good summary of, M&A terms, what market is, pros, cons. And, as you're looking at M&A transactions, that's a good valuable report to have a look at and see if there's anything there that resonates with you. I want to thank all of our panelists virtually and here in person, and all of you for making this a really interactive, engaging, interesting afternoon. If we could give our panelists a round of applause, that'd be wonderful. And also to our DLA team, who's done a great job of bringing this event to life. Our articling students, our IT team, marketing, biz dev, office services. There's been a lot of effort that's gone into this event, not only from the DLA team, but from each of the respective teams at each of the presenters who've made significant efforts in bringing this event to you. So thank you again to all of you. And last but certainly not least, we have a reception in the boardroom next door. There's appetizers, snacks, drinks. Please help yourself. Stay engaged, get to know one another. And we'll have one of our students stationed at the patio door, opening it up for security if you want to enjoy the weather outside. It's beautiful. So enjoy the fresh air. And thank you again so much to all of you for coming and being here today.